Morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Sonal Boothra. Well, we're counting down to the close of Friday, but also 25 years of CNBC-TV18. So we're all set to celebrate, 25 years in the India Business Leader Awards tomorrow. But for the markets, high for the 6th day in a row. And pretty much they got what they were expecting and wanting. A CRR cut, unchanged repo rates, and markets have moved on. Like the mid-cap index is now up close to about 0.5%. And this week, it's put in a close to a 4% gain.
Oh, yes. And, this is something that, as you said, was expected. Markets got what they wanted. And that's why the kind of reaction, it's a milestone day for us, for sure. A big announcements in the RBI policy meet as well. So, till the time there was no mention of CRR cut that came by, markets saw that sharp dip. That was around 10:30. But the moment we heard about a CRR cut of around 50 basis points, Bank Nifty surged, and that led to the markets going higher as well. For now, we are at the day's high as far as the markets are concerned. Nifty is up 27 points. Mid-caps are outperforming the benchmarks. Bank Nifty is up around 204 points. So the street likes what RBI governor said today. However, the cut in the GDP growth forecast, the higher inflation estimates is something that we need to discuss in greater detail. Of course, we'll get more comments in the press conference that's slated at 12 p.m. today. And you can tune into CNBC TV18 for all those updates. But let's discuss this and a lot more with Ajay Srivastav, CEO of Dimensions Corporate Fin Services, joining us now. Ajay, good morning. Thank you so much for joining in. Well, the street got what they expected in terms of CRR cut, but there's a slight revision in GDP growth forecast as well. What do you make of the commentary that came by? And is this something that means that February will see the cut finally in terms of rates?
I don't know what February will look like, but certainly for the savers, it's not a good year ending because there were kind of deposit rates they were getting. The banks will kind of put a halt on it for some time. It's not that 1 lakh crore is a very large sum of money for the system, but for the time being, it gives them ability to hold on to the deposit rate, which they're doing it. But I would still say that, when you try to, the failure of controlling inflation is hitting the economy everywhere. May not hit the stock market, and I'll tell you why. But the fact remains that you don't control inflation, and it's been a failure. It's been, 3 years now? We haven't been able to go below the 4% target rate, and RBI is saying they will not be able to do that till the next quarter of financial year. It tells you a story for the bottom segment of the population. It tells you a story of why consumption is slowing. It tells you a story about the fiscal impact of the tolls which the government are giving out to win elections, because the bottom strata of the society is really feeling the pinch. In stock market, one of the best part of stock market is we are kind of quote unquote unrelated to economy, because so many new companies are coming up in India, the newcomers, which are taking away business of Kirana stores, giving phenomenal returns to us. So many new pharma stories, so many new engineering stories are coming up. So stock market has its own logic, its own way of working. And to an extent, it's kind of an India dealing from the economics. So you had a situation of the growth rate going down and the market going up. Has happened many times in the past, will keep happening here. But bottom line is the fight for controlling inflation has been lost by the Central Bank of India. And I think today was a sad day because I really respect the RBI governor. I really enjoyed all his commentary. Today was the first time I saw the body language down, the shoulders slouching and saying, you know what, I didn't win the war against inflation, and that's going to hurt us.
But maybe he'll have another term, Ajay. We're still getting clarity. We're still awaiting clarity on whether there is a term extension, and he was absolutely quiet on that front.
Well, he can't say, give me extension, can he? Absolutely. And I think it'll be rightfully perhaps to give him extension, but I always am a firm believer, new blood is always good in companies, in government, everywhere. So to that extent, if we have a new governor, maybe a new way to do it, because, you get tired of carrying the burden for some time, and that's time to put it on. He's done a good job. He's gone through COVID. He's done a fantastic job. Lost a fun battle, but kept the economy going. So I think on a whole, one would rate him as quite one of the finer governors RBI has had. But I think inflation is a weak point. And today, when you do the CRR cut, why would you do it? If you're fighting inflation, you want liquidity to be sucked out. So he's got a battle on liquidity. He's got a battle on dollars. You saw the steep 200 or 300 basis point increase in limits of FCNRB deposits up to March 25. That smells desperation for dollar deposits. That smells desperation. Not good for the rupee. Longer term, short term, today may be a blip. But the fact remains, I think we are now reaching a point where we need more dollars desperately. So I guess, for a stock market, a lot of mixed things. We're going to go back and analyze what it means for us. But bottom line, what it means for us is we don't want to buy into this market. We want to stay put with what we have invested in, keep some cash on the side. It's going to be tricky as we go down the path of lower and lower growth rates, as most of your economist panel was telling us that RBI, I think, overestimated the growth rate. So keep powder dry for the market. I think you will get chances to buy more, as you just saw 1 month back.
Actually, that was going to be my next question, Ajay, because a lot of economists are expecting downward revision to the growth forecast made by the RBI as well. And as you pointed out, there's a disconnect anyway between stock markets and how the economy is doing. So what are the reasons you think markets will continue to see a downtrend? Is it only inflation? Is it low growth rates? Or do you think generally the FI versus DI debate both will come at par someday, and we will continuously see those flows as well?
See, the problem with FI is that even for Indians, the US market is doing phenomenally well. And they keep doing well. And you saw what happened to crypto last night. Indian investors have not invested too much in crypto for RBI regulations, income tax, and not availability easily. But the ETF opening up, crypto ETF in the US, just changed the dynamics altogether for global investors. So I think Indian investors would weigh themselves more towards US market, will go towards crypto, will go towards gold, will go towards silver. I think that's one of the things which will keep them going for some time at this point of time. And number two for us is the most important thing is the budget is coming up on February 28th, which will give us a lot of pointers as to where the government's expenditure is going. Because our analysis team has analyzed that the way the dole policy goes on, it'll be almost impossible for government to do a major increase in capex budget and balance the fiscal deficit and still give out those helicopter money of 2,500, 1,000, 3,000, 4,000 per person that every government is announcing. And I just saw in Delhi they announced, AAP said 250 unit. People said, my God, they're giving freebies. Congress just came up and said, give 400 units free. It's a race to the bottom and this is where we see the problem to the economy, that how much money will go towards helicopter money and how much will really go towards generating good quality returns to capital. So we have to digest the results, we digest the budget. So that's why I said, keep powder dry. Where we are invested quite well, everybody's invested quite well. But Nifty 50, that's where the problem sits. Because those companies are heavily dependent on the economy and consumption at the lower end, and they are struggling to perform. So my guess remains that mid-cap will overperform and really do phenomenally well, including new companies, and Nifty 50 will struggle its existence. Some will do well, some will do bad, but Nifty 50 is a problem today in the economy.
Ajay, at the start of 2024, did you anticipate that Nifty would be up 13-15%, mid-caps would be up 27%? Did you expect this kind of a return? And what were your key learnings from the market and the trends that it's taught you for the way forward?
I think, our targets are much higher for our returns, of course. 13-15% doesn't bite us because might as well go buy debt or gold at the end of the day and then stop working. So, so this doesn't excite us. The inflation is 8.5% or 9%, depending what you want to buy. If you want to buy real estate, inflation is 100%. What you could buy last year for 5 crore is 10 crores today. So to that extent, Rima, having 13-15% expectation of return and being in the market doesn't make sense to anybody. You might as well put money in mutual fund and go home and sleep. But our expectations are good. They have been met in large way. And I think one of the reasons they have been met is this huge surge of IPOs, and most IPOs have done well. So private placement market, both internal unlisted shares, has performed phenomenally well for investors. IPO has done extremely well. In fact, most companies have given, really good returns. And the best part, the new economy companies, the larger ones, they have delivered returns. So, we were confident of what we were doing in the start of the year, keeping away from banks, keeping away from Bank Nifty and focusing on these companies. Few in Nifty, of course, like something like Trent or Indigo perhaps, but that's about it. But the fact remains that our mid-cap story continues to be strong, IPO story continues to be strong, and that is where the returns have come in this year. So no reason to be pessimistic. That's why I said, forget Nifty 50. That's for your grandfathers. You need to focus on the rest of the market. That's where the action is. Let somebody else go spend money on Nifty 50 companies. Maybe one or two good enough, and that's all about it. I was just calculating. You won't believe it. We have exactly 3 companies of Nifty 50 in our portfolio. That's all.
But why even ask grandfathers to invest in Nifty then, right? Everyone should make money if that's the case. But Ajay, thank you so much for joining in today with your thoughts on the markets. Well, that's some fundamental opinion coming in on the markets and the outlook on the sectors as well. We'll slip into a short break. Up next, we'll discuss what's buzzing in the commodities space with Manisha Gupta as always. Stay tuned.
For more news and updates, all you need to do is follow CNBC TV18 on all of our digital platforms.
Welcome back. You're still tuned into Trading Hour. It's time to shift focus on the commodity space. Manisha Gupta is joining in now. Manisha, what's the commodity on your radar?
Well, I'm looking at the crude oil prices. The much-awaited important meeting is now done with, and the OPEC and allies on expected lines have said that they will postpone their increase in output, and they would do it only by the first quarter of 2025 now. So that really is what the markets are dealing with right now. Well, apart from that, it also is about OPEC saying that they will also withhold 5.8 million barrels per day for another 4 months now. The street sees this as a spare capacity that the world has at this point in time. It also is about the U.S. crude inventories, which, by the way, have declined by 5 million barrels. But when you look at the U.S. production, that is at record highs. And once the new president in U.S. comes in, the expectation is that you could be looking at this number growing further going forward. Well, the U.S. jobless claims data that came in yesterday has been on the positive side, is the reason you've seen dollar index gain up and the U.S. Treasury yields gain up as well. And that's another reason that you have seen pressure come in for prices. For today, it's going to be about the U.S. non-farm payroll data. 200,000 jobs for the month of November is what the street is working with. Anything more than that or less than that is what would give you another reaction coming in for prices.
Thank you very much for that. We will slip into a break on that note. On the other side, we'll invite Suraksha Diagnostic. They listed today. It's been a flat debut. They're largely Kolkata-based companies. So we'll get more details with the top management. Welcome back. Diagnostic services provider Suraksha Diagnostic has had a flat debut on Dalal Street. The IPO price, issue price was 441, and as we speak, it's dipped slightly below that, down close to about 4%. This is a company which largely caters to eastern and northeastern India. So nearly 95% of its revenues come in from West Bengal, where they provide diagnostic, pathology, radiology services. Dr. Somnath Chatterjee, founder, promoter and chairman of the company, and Ms. Ritu Mittal, who is also the promoter, joint MD and CEO, join us on the show now to talk about the way forward. Thank you very much and congratulations. This is Rima here. We had spoken earlier on IPO KYC. So, now that you're listed, and for the benefit of all the new shareholders who believe in the Suraksha story, take us through what they should expect on growth and margins going forward. Give us a near-term outlook, 1 year, and even over the next 5 years. How will Suraksha Diagnostics as a company evolve from here on? Dr. Chatterjee, if you would like to go first.
Regarding the growth story, it is going to be extremely robust. As our CEO will explain it to you, that there has been extensive plans for growing the chain forward in the next 3 years. Ritu, you pick up.
So, diagnostics is a regional play and it's a trust-based business. Therefore, we would first like to expand throughout West Bengal and then enter the neighboring states of Northeast, followed by Bihar, Jharkhand and Orissa. That's the plan going forward. We do intend to put up 12 to 15 centers every year. As far as the margins are concerned, as demonstrated by our peers, it's just going to get better as operational efficiency sets in and we get the operational leverage.
So how long does it take for a new diagnostic? Yes, please go ahead.
Historically, it has been seen that with the growth of the number of centers that you have, there is a remarkable increase in the turnover of the company as it goes. So, with a robust plan of growth, we can expect better than market CAGR that is currently available.
Okay. So, you know, the earlier conversation that you had indicated that margins will improve to around 40 to 42% versus current 35%. How soon do you think you can get to that mark, and what would the drivers of that margin expansion be? You spoke about, of course, the additions in terms of diagnostic centers that there are. Will there be any other factors other than store addition? Will you see price hikes as well? How often does it happen, since it's a regional play, but it's a competitive market as well?
So historically, Suraksha has been increasing prices at about 3 to 4% every alternate year, and we would continue to do so. As far as the margins are concerned, it is basically coming out of expansion, because as your base grows, your margins just improve because your fixed costs get divided. And we are also planning to add a lot of tests, high-end tests, to our portfolio, which will again contribute to revenue and also margins in the Eastern India zone.
There are these high-end tests which we call esoterics, and Suraksha today is the only lab performing most of the esoterics. And on top of that, it plans to expand the menu to a complete one in the next 3 to 4 months. So we believe that as we add the esoteric component in our menu, the profitability, because these being high-end tests, the profitability will rise considerably because of this.
Ritu, since you'll have aggressive expansion plans, you spoke about 12 to 15 centers being added every year. I remember from our earlier conversation, even an acquisition was something that you were open to and looking at. So how are you planning to fund all this? Because in the IPO, you all have only done an offer for sale.
So we have cash accruals in the book, and the company is cash rich. There's hardly any debt in the balance sheet. So we typically plan to go through accruals that the company has. And if required, if we get an acquisition which we find worthwhile, we can definitely raise debt for the same.
Okay. What would that acquisition kitty be? What's the cash in the books right now? Is there something that you already have your eye on and we could hear about it, say, in this fiscal or the next calendar year?
So cash in the books is around 50 crores. And maybe you will hear about some acquisition in the next fiscal year.
Okay.
You mean in FY26, not before the close of this fiscal year, which is March 2025?
We will definitely try to bring a closure to it.
Okay.
But since we have all been involved in this IPO process, things have got a bit delayed, but it will be sooner than expected, the acquisition that we are talking about.
Sir, since you have an eye on a target clearly, the one that you're referring to, will it require you to go out there and raise debt? Is it a large acquisition, or will your internal accruals be sufficient?
No, it is not a large acquisition, but it is a very niche acquisition. So we will not need to raise any debt because of it. But this niche emerging field of medicine will give impetus to a very large growth in the whole ecosystem of Suraksha.
Okay, all right. So, Ms. Mittal, I wanted to understand the current market share that you have in West Bengal, and if you're looking at other eastern states as well, what kind of capex will you put in for that?
So we planned a capex outlay of around 70 crores every year going forward for the next 3 to 4 years. And the market share that Suraksha today has for East India is around 1.3%. But again, East India is a huge territory and Suraksha is present in a very small part of it. If we were to consider our market share in territories where we are heavily present, it would definitely be upwards of 10%.
Thank you. Thank you, Dr. Chatterjee and Ms. Mittal for joining in, and wish you all the best and look forward to more conversations with CNBC TV18. We will slip into a break on that note with the news that things are still very quiet, at least on the Nifty and the sensex, marginal red, but the mid-caps are holding up in the green. On the other side of the break is our special segment, Fin Street. We'll put the spotlight on how banks have performed in the second quarter.
Welcome back. You're still tuned into Trading Hour. It's time to get our special segment, Fin Street. Abhishek Kothari is focusing on how banks have performed in the second quarter of FY25.
Post Q4 FY24 results, CNBC TV18 did mention that net interest margin of lenders can come under pressure, credit cost will rise and asset quality will also deteriorate owing to normalization. So what has happened? Net interest margin of the lenders continued to remain under pressure for last 2 quarters in a row. Credit cost is rising. Some banks have even raised their FY25 credit cost guidance in this quarter. Pain has continued, especially for lenders having exposure to rural market like microfinance loans, and now even for lenders having exposure to unsecured retail loans. So PSU banks, their net interest income saw decline on a sequential basis for second quarter in a row. Private banks, their NI growth was around 1% on a sequential basis, led by high-yielding retail loans. Tamil Nadu Mercantile Bank, Union Bank of India saw YOY and quarter-on-quarter decline in their net interest income in Q2 FY25. Dhanlaxmi Bank is perhaps the only lender to see YOY decline in its net interest income for third quarter in a row. Now, calculation shows that sequentially net interest margin might have declined by 10 basis points for PSU banks and by about 9 basis points for private banks. So overall, net interest margin has declined sequentially for all the lenders by roughly about 10 basis points. Operating profits grew slower for private banks versus PSU banks. PSU banks' operating profit growth was led by robust treasury gains that they had in Q2 FY25. Overall, operating profits grew by 19.5% YOY and close to 7% sequentially. In this, the operating profits of PSU banks grew by 11% quarter-on-quarter, and that of private banks grew by nearly 2.7% on a sequential basis. Operating profits declined YOY and quarter-on-quarter for lenders like ISAF SFB, Karnataka Bank, IndusInd Bank and Ujjivan Small Finance Bank. 11 out of 39 lenders saw their operating profits decline on a sequential basis. Now, banking sector has reported their highest ever quarterly PAT. So, PSU Bank's PAT growth was robust on account of the fact that they had treasury gains and lower provisioning in this quarter. PAT of private banks was impacted from credit cost or elevated provisioning on unsecured retail loans and MFI loans which slipped into slippages. Overall, banking sector's PAT grew by nearly 3.5% quarter-on-quarter. ISAF SFB is perhaps the only lender to report net loss in Q2 FY25. Now, PAT declined YOY and quarter-on-quarter for lenders like Equitas, IDFC Bank, Utkarsh Small Finance Bank, IndusInd, Ujjivan, RBI as well as Suryodaya Small Finance Bank. 11 lenders saw their earnings decline on a sequential basis. Let's take a look at the asset quality, which has been the best ever for the entire sector. Now, private bank slippages increased substantially when compared to that of PSU banks. Private banks' quarterly slippages increased by 2.7% quarter-on-quarter when compared to a decline of nearly 3.5% for PSU banks. Overall, slippages declined by 0.1% quarter-on-quarter for the entire banking sector. Now, slippage ratio remained healthy or below 1.3% in Q2 FY25. Slippages were elevated for players, especially in the microfinance and unsecured retail credit like ISAF, Utkarsh, Equitas, Suryodaya, etc. Asset quality of the banking sector is the best that you are seeing in last 10 years or even more. And if you take a look quarter-on-quarter, the net NPA ratio or the net NPA has increased for private banks for second quarter in a row. Interestingly, the net NPA ratio difference between PSU banks and private banks is only 11 basis points, which is the lowest ever in last decade or even more. In terms of outlook, let's take a look at what analysts and lenders have to say. While lenders would focus on protecting themselves from increasing credit costs, the loan growth for majority of them may take a backseat. Net interest margin may struggle in the near future. Credit costs seen elevated for some players, especially in the near term. Now, the gap between deposit growth and loan growth will continue to narrow. OPEX will be a key monitor to manage profitability in this tough cycle. Peak profitability is behind and valuation is inexpensive, which means that it is largely priced in. PSU banks have outperformed private banks on certain parameters like operating profits, profit after tax, slippages, as well as asset quality. So in Q2 FY25, laziness got paid off while aggression saw some pain.
Okay, thanks Abhishek for that. We will slip into a break on that note. We'll come back with more on the market.